Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. Well, it's a Friday where we don't have to say that the war continues into whatever, 6th or 7th week. I think it would have been 7th week if the war was on. There is a ceasefire. It's looking a little better. It was looking very tricky when we started, yesterday morning, same time, whether the ceasefire is fragile. Well, it still is fragile, but statements, etc., coming through on sticky points that people are ready to talk. Talks, of course, are scheduled in Pakistan, Islamabad on Saturday. So we'll see how it goes. Markets in better shape overnight. Once again, I'm Prashant with me, my colleagues Nigel and Reema. Guys, hi, morning.
Hi, and separately, even the fact that Israel is saying that they are looking to have a direct engagement with the Hezbollah to resolve the issue
not Hezbollah.
With Lebanon to, resolve that issue. I think that's also an important sticky point. But I think for us, the key is, and for everyone, whether traffic passes through the Strait of Hormuz, and as of now, at least, it's a bit of a trickle.
Well, that's right, and cooling off of crude prices as well. That's something that we'll be tracking. So, not just markets, we need to put on the political hat as well nowadays and do some analysis. So, let's get straight to the action, Prashant, and hopefully you're not here tomorrow morning. In case something breaks at the global front.
No, I think the talks are on, right? Tomorrow. So all headlines there. I think there's a 30-minute difference. So it's not going to be, it's not Washington, Bombay. it's Pakistan.
So you're not in.
Yeah, we'll see. But anyway, let's just take a quick look at what markets are going to look like and take it from the top, right? So the S&P was up 0.6%, which basically means that the index has been on a 7-day winning streak. That's not bad at all. I mean, the Nasdaq is up, I think 10% now in the recent past. Has been a winning streak as well. So it's basically recovered. I think the S&P not quite, but the Nasdaq certainly is back to its pre-war levels, pre-27th of February levels. Now, we've been pointing this out. The major point of contention about the ceasefire is whether Lebanon is part of the package, the ceasefire package or not. And, Iran was saying no, US and Israel were saying yes. Now, Israeli Prime Minister Benjamin Netanyahu has said that he will open direct negotiations with the Lebanese government soon. But at the same time, he's saying that they're going to continue to strike Hezbollah forces and with full vigor, etc., etc. So we don't know what this would really, at the end of the day, entail. Because Iran, of course, has been very steadfast in saying that these strikes have to stop before negotiations can start. By the way, there was another story which said that President Trump is the one who called up Netanyahu and told him that, the quote was, you got to go a bit low-key. There was a Wall Street Journal story, and he said that, can't have this while we're trying to have negotiations to start. Now, oil futures are trading around the $97 per barrel mark, and so not very different from where we were yesterday. There's reports that only 8 ships crossed the Strait of Hormuz on Thursday. Number used to be 100 plus, 120, 130 a day. So now it's about 8, which is not exactly great, but we'll see. Iran's deputy foreign minister said that anyone who communicates with the Iranian authority has permission to pass. And of course, President Trump has been saying, and actually he had this quote will come up. Iran is doing a very poor job, dishonorable, some would say, of allowing oil to go through the Strait of Hormuz. That is not the agreement we have. So that's President Trump. So again, on the 2 points of contention, the Strait, how it's going to be taxed, tolled, who controls it. And of course, the other one is Lebanon and what happens there. The talks are in Pakistan, remember. Wall Street Journal, by the way, said that, the Iranian delegation led by the foreign minister and the parliament speaker have arrived in Islamabad, in Pakistan, yesterday late evening. Then, the Iranians said, well, that's not true. It's not correct. From the U.S. side, it's most likely going to be J.D. Vance, the U.S. vice president, who's expected to lead the negotiations. As I said, the negotiations are set in Islamabad tomorrow. So we'll see who turns up from both sides finally and how the negotiations really go. I just want to leave you with levels here as we go into another trading session and ahead of the weekend as well. So the support for the Nifty is 23,662. It's a very short-term sort of upward sloping trend line and this 23,662 level lies on that trend line. It's a very minor near-term, but it's that kind of a market we're in. So work with the 23,600, 660 kind of levels on the downside. If the level holds, then you're basically looking at, and we've said this over the last couple of days, 24,100, perhaps stretching all the way to 24,300 possible. So those are targets which the Nifty will eventually look to get to. GIFT Nifty will give you a quick sense of how we're likely to start, and then we will pick it up from there. It's about a 50-odd point normal kind of market open that the GIFT Nifty is indicating. FNOQs and the options data. Nigel has walked across to the wall. Nigel, over to you.
Well, that's right, Prashant. The ceasefire has been announced, but business through the Strait of Hormuz is far from normal. And there are two factors that I'm tracking out here. The ship traffic is still running below 10% of the usual volumes, and we're seeing that the prices of physical oil remain near all-time highs. That's the sign that supply disruption is still being felt. So if we look at two cues from here on, besides the equity markets, it's going to be the traffic through the strait, as well as the physical price of crude oil prices, which are at a sharp premium in comparison to the futures. Let's come back home then. On the flow side, the DIs were buyers in the cash market, while the FIs, they continue to remain sellers. However, there are signs of selling exhaustion gradually creeping in from the FIs. And a relatively stable rupee, that's offering some kind of support. So from those high levels of 8,000 crores on a daily basis, it's down to 1,700 crores or thereabouts. And you'll want it to hover around these levels. As I said, the rupee strength is something that they like. In the derivatives market, the FIs, they unwound some positions on index futures, both on the long as well as on the short side. The short positioning, though, continues to remain elevated at around that 80% odd. Though the FI overall stance in the derivatives market, it seems to be a little bit defensive. I say this because they added more shorts than longs on stock futures, and also they are aggressively writing calls. In that ratio, I think we should get those calls that they have been writing in the ratio of closer on 2 calls for every 1 put. So defensive stance is what they have in the FNO market. Well, we have notably seen that the 23,800 call, 23,900 call, both of them saw aggressive writing, suggesting that that recent high of ballpark around 24,050, that could act as the first level of resistance. The broader trading range, though, seems to be around 23,300 on the downside, and on the upside, it'll be around 24,500. That's basically aligning with the 20 as well as the 50 DMA. If you pull up a chart, you'll see we're pat in the middle of that 20 as well as the 50 DMA. On the positive side, well, the broader markets, they have remained more or less resilient. Even in yesterday's trading session, you had the mid and the small cap indices. They, in fact, ended in the green. They outperformed, and there are signs of renewed buying out there, indicating there is some kind of rhythm coming back into the broader markets. Looking ahead, well, tech is going to be in focus. TCS results, Wipro's buyback, and some caution around global tech trends as well. Despite all of that, I think even if the tech index sees some kind of pressure, it appears it still has some unfinished business on the upside. So I'll keep an eye out on the tech index as well. Net, we started off in the green. Hopefully, we build on that and move towards the 24,000 odd mark.
Thank you very much for that. It's finally a Friday, guys. And, barring the little bit of profit booking that we had yesterday, it's still been a good week for us, courtesy the monster rally on Wednesday. So week to date, the Nifty is up 4.5%, while the mid-cap index has seen a rally of more than 6%. Let's get to the equity calls then. It's Aditya Suresh of Macquarie who says that India has underperformed the emerging markets by nearly 50% since 2025 on persistent FI selling. Still, the building blocks to support a near-term reversal are missing. He says from a negative view in 2025, Macquarie had turned mildly optimistic for 2026, but now with a disrupted global energy market, they revert back to a guarded stance. For sustained market outperformance, what's the aggregate earnings profile that needs to improve, and the typical 500 basis points EPS growth premium to emerging markets is yet to resume. So that's the call coming in from Macquarie. Good time then to get in Nomura then and find out what the outlook and the view is for the Indian equity market, especially in context with the Asia-Pacific region. Chetan Seth, Asia-Pacific equity strategist at Nomura, is now joining in. Chetan, hi, good to have you this morning. So you downgraded Indian equities on the 1st of April. Why? We get that India is vulnerable to elevated energy oil prices, but your own report goes on to say that technically India does appear to be a bit oversold, and there is a possibility that perhaps we're on the path to de-escalation from a conflict point of view, so oil prices may not stay at very elevated levels.
Yeah. Well, first of all, thank you for having me on your show. So First of, we need to understand what this downgrade means, right? I'm a regional guy. Most of our investors are regional investors. So when we say we are downgrading our stance from an overweight to a neutral, all we are trying to suggest is that we think the market performance of India will be broadly in line with regional markets. So the thesis is very simple. If, let's say, the war were to de-escalate from here and we start to see normalization of oil and energy flows through the Straits of Hormuz, I think all the markets in Asia will rally. Some markets will rally more. We think probably the tech-oriented markets like Korea, Taiwan will probably rally more. India will also rally more, but hard for us to expect India to outperform from here. So the big call really is what happens to the war and whether we see a sustainable truce, ceasefire, and whether oil actually starts to flow through.
So, Chetan, in the Asia Pacific region, you're overweight, you like Korean equities in China. Are these the two big bets?
That's right. So for the case of Korea is very simple. The earnings growth profile for Korean equities will be very strong. The numbers are changing literally every week, and we're having a hard time to actually catch up with our numbers. As of now, the latest numbers for earnings growth expectations for 2026 is 150%. On top of that, you'll probably see another 20% growth next year. We had Samsung results a couple of days ago. Numbers were quite solid. In fact, they were on the higher side of the street consensus. So earnings growth for Korea will be quite strong. Valuations trading at 7-8 times. So we think if those earnings expectations materialize, I think there is significant upside on Korean equities. In fact, I would also add that Nomura tech analysts, and some of these analysts have been covering the tech space for last 20 to 30 years. They are quite bullish on the AI tech cycle. If anything, our numbers are ahead of consensus. And in my scenarios, I've not even yet taken into account those very bullish estimates. And for China, the case is very simple. Valuations are obviously much more modest, and relative to India, China does have resiliency to any disruption in oil and energy flows. The one thing I will also add quickly is that for India markets, there are two things we need to nail to get the call correct. Very simply, you have to get the call correct on energy, which is a function of war. And second, the call on tech AI. If you're bullish on AI tech and you are negative on oil in terms of expecting oil to go down, I think India will struggle. Let's say you start saying that the tech cycle is turning and oil energy flow starts to normalize, war over, then India will outperform from here.
Chetan, morning, Prashant here. I mean, I think the two largest economies in the world, US and China, I mean, if you rate countries most exposed to an energy shock, I mean, I think US and China perhaps the least exposed, right, to a big energy shock. And that's I guess, the reason why global equities, etc., are not crazy panicking in that sense. But yeah, there are very vulnerable, slightly lower income energy importers as well. And perhaps, India falls in that bucket. Just one thing though, Chetan, in markets, which is what you track, right? Asian markets, etc. It's often been said that Korea and Taiwan, etc. They're like one or two trick ponies. It's AI, it's tech, etc. Is that really true? Or do you think when we say those markets will do very well? I mean, I think I don't have the exact numbers, but 2025, 70% run in Korea. If you see who was responsible for that 70% run, I mean, I think it was just 2 or 3 names, right? Accounting for bulk of those gains. How does one account for that? What are investors saying about that?
Yeah. So first of all, to an extent, it is you may say they are, one trick pony or something of that sort, but it is what it is, right? And so long as that pony is running, you have to run behind that pony. But I will just caveat by saying that for last year, Korea did very well. It was not just memory. Everything in Korea rallied. Defense, they have defense stocks. These are some of the globally competitive companies. They've got transformer companies which are supplying these transformers to the US market because of the data center demand. You've got medical, beauty, entertainment stocks, all these stocks were quite oversold. And you saw a big rally in these stocks. The other theme which also helped Korea market was the theme around ESS, which is related to batteries. Again, you've got Korean companies which are quite competitive. So I would not say that was just one sector. But looking forward, actually, you're absolutely right. The big part of the Korea bull case is now premised on memory, or these two stocks, which are 55% of MSCI Korea. If that call is wrong, I think Korea will struggle, but that's not our view. Taiwan, yes, pretty much 80-85% of the market is tech or derivatives of tech, but pretty much every stock is some form of a leverage on the AI thematic, whether these companies are doing chips or components or wires or cables. So you could make a broad-based comment that it's all about tech in Taiwan.
Hi, Chetan. Good morning and good to see you, Ben. What are you making of these FI outflows? They seem to be very, very aggressive, particularly in the last 45 days, maybe with good reason, because, we're not very, very cheap, though we've gone through a phase of consolidation. And obviously, with the outbreak of this war, crude oil prices spiked up. That said, now the rupee is showing some signs of stability after underperforming for a goodish bit. Do you think now that selling outflow at least will reduce in comparison to what we have seen? Otherwise, they're going lock, stock and barrel.
Well, it all depends on war. I feel, our top-down thinking is that there are still binary risks. Anything could happen from here. But of course, I think the developments over the last 24, 48 hours are encouraging. And just hope that things actually settle down. If things settle down, I think Asia will see inflows. India will also see inflows. In fact, India has seen outflows of, I think, $16-17 billion year to date. Korea has seen around $30-32 billion. Taiwan has seen another $14-15 billion. So all that money is sitting on someone's books and has to come back to markets if things stabilize. But the reason for India's underperformance is, or let's say persistent net selling by foreigners, is very simple. Is that, look, our investors can find opportunities elsewhere. They can find opportunities in tech, and that's where they were buying, and they had to sell somewhere. It's not that EM active funds are getting a lot of money. Passives are getting a lot of money, but actives are not getting a lot of money. So whenever you have an opportunity, you have to cut somewhere and you have to buy something else. The other problem for India is also rupee. I would say rupee is rupee and equity flows is a chicken and egg issue, right? If flows start to normalize and get better and we start seeing inflows into India, rupee will also stabilize. But so long as foreigners are selling, rupee will come under pressure, and it will further put additional pressure on equities, and foreign investor sentiment will probably remain subdued.
Chetan, great chatting with you. Thank you very much for joining in. Nomura's base case is that we end the year with 24,900 on the Nifty, which means actually this year equities could see a downside because we started the year with the Nifty around 26,000. Thank you once again for joining in on CNBC-TV18. Let's slip into a break. On the other side, we'll drill it down to individual stocks. This is our top 10 segment. We're looking at Wipro, IRB Infrastructure, Godrej Properties, Prestige, Godfrey Phillips India, BSC, Satvik Energy. These are the stocks which could open up in the green. TCS will react to numbers. JSW Steel, Poonawalla FinCorp also on our radar. Get into a break and we'll come back and talk about this. Welcome back. Let's talk about stocks then. This is CNBC-TV18's list of top stocks for the day. And let me begin that with TCS. Now, TCS has largely delivered a steady set of numbers. Constant currency revenue growth for the company has come in at 1.2%, the third consecutive quarter of growth. Margins, though, have expanded by only 10 basis points, 25.3%. Now, this is a tad bit disappointing considering that the company said that they got 110 basis points currency tailwind on their margins, but they chose to reinvest it back into the business. And therefore, the actual pass-through to the P&L has only been 10 basis points. The AI revenue numbers, the deal wins, the hiring, all these are positive signals. So the company's AI revenues now stand at 7.5% of the overall revenues, having seen a growth of 25-30% quarter on quarter. Deal wins super strong, 3 mega deals signed in the quarter. $12 billion is the total contract value, and headcount has gone up by 2,300 on a quarter-on-quarter basis. And plus, there is a wage hike effective 1st of April. The company says they are entering FY27 with a lot of positivity and optimism, considering the strong deal wins that the company has seen. So overall, it's a good set of numbers. There are no positive surprises, no negative surprises. Maybe you can quibble a bit about the margin performance and the rupee benefit. But the stock did well yesterday. It was up 1.2% yesterday, and from the start of the month, it's seen a rally of close to about 10%. So is there enough in the numbers to keep the rally going? The other one, which I'm watching very closely, is Wipro, because Wipro has said that on 16th of this month, along with numbers, they will also consider a buyback. Now, this comes on expected lines. Investec says that we're expecting a buyback of 16,000 crore rupees. Even Morgan Stanley, in their preview note, said that we're expecting Wipro to do a buyback. The last buyback done by Wipro was in July of 2023. It was 12,000 crore of a buyback. Now, Investec says the analysis for coming to that 16,000 number is the company has 41,000 crore of net cash on the books. Assuming they deploy 20% of the shareholder funds, then they could do about 16,000 crores. So it's a positive, but it confirms what the market was anticipating.
Okay, all right. Thanks a lot for that, Reema. Well, I'm looking at JSW Steel, not a big mover in terms of the reaction to the operational performance, but since it came out just highlighting, it looks a little bit subdued. The Indian operations, the crude steel production was down 1%. The combined crude steel production was down close to around 2%. And for the year itself, they've actually done relatively better because capacities have come on stream. So the consolidated number is a growth of close to around 8%. Net, I mean, maybe quarter four is a little bit subdued, but there is a lot of buoyancy in the steel, the ferrous, as well as the non-ferrous market. So there is any kind of dip that could be bought into, though the valuations are at the upper end for this particular company. But I'll hop across to Vivek. He's here to tell us about Poonawalla FinCorp as well as IRB Infra. Morning, Vivek.
Well, good morning. Yesterday morning we told you about how Poonawalla FinCorp was likely to launch a QIP, and last evening, along expected lines, the company launched a QIP to go ahead and for a fundraise. Now, the base size of the QIP is 2,500 crore. Now, the company may exercise the option to go ahead and upsize this particular fundraise as well. The indicative issue price is at close to 370.7 rupees a share. This is at the bottom end of the indicative price band. The equity dilution at the base size will be slightly above 8%. And the usage of the proceeds, number one, it will be used for growth capital. The company may also use the funds for debt repayment, and also a certain amount may be used for general corporate purposes. Now, coming to IRB Infra, strong growth as far as March toll collections are concerned. IRB Group, which is IRB as well as the publicly listed InvIT and the private InvIT, have seen toll collections of 783 crore in the month gone by, up almost 21% on a year-on-year basis. FY26 toll collection robust at over 8,200 crore. But remember, this on an expanded base, and the company had quite a few new assets coming on stream.
All right. Thanks very much for that. Sonal is joining in now with Godrej Properties and Prestige Estates. Sonal, morning.
Good morning, Prashant. Quarter four updates are coming in, and for Godrej Properties, it has reported the highest sales in the listed universe in FY26. For quarter four, their collections are up 14% YOY, 86% sequentially, and sales are up 21% sequentially to come at 10,163 crore rupees. Collections grew by 17% on a YOY basis, close to 20,000 crore rupees in FY26, and sales came in at 34,171 crore rupees. They have actually achieved 105% of their bookings guidance already. However, collections are just 95% of their guidance, and that, of course, is a negative. The company says the momentum continues, and that is across geographies. For Prestige Estates, the company is making another entry in Mumbai, and this is in the Versova area, which is in Andheri, and this is with a JV with a developer which is in Mumbai and Pune, which is ABIL Group. The total development potential here is 1.7 million square feet with a revenue potential of 9,000 crore rupees. So continues to make strides in the Mumbai market. These two stocks will be in focus today.
Got it. All right, Sonal, thanks for that. Let's hop across to Vinny, though. She's joining in on a Friday morning to tell us some of the stocks that are going to be in the news. Morning, Vinny.
Good morning, Nigel. So first up, let's talk about Godfrey Phillips. Now, there was a case that was going on Godfrey Phillips, and this was a case that was filed by 24/7 Retail as well as Sameer Modi, who was once on the board of the company as well. This case is going on since 2024. Now, the Delhi High Court has officially recorded the withdrawal of this case. It was more like a family feud that was going on over the sale of this 24/7 Retail. The case is now fully closed, so that becomes a positive for Godfrey Phillips. So green is something that we could see here, given that this overhang actually comes to an end. BSE Green expected here as well. They've received a nod from SEBI to launch the BSE focused IT index derivatives as well. So one more product coming in for BSE, could see some increase in volumes over there. That's the anticipation, but as of now, positive there as well. Satwik Green, we're expecting green on the screen for this one as well, as the company subsidiary has received an order of around 109 crore rupees. This is an order from an independent EPC player as well for supply of solar PV modules. They have received a lot of orders in the last couple of months as well. So important to see the total order book in Q4 in their earnings as well.
All right, Vinny, thanks very much for that. Well, that's stocks with news flow as we run into the market pre-open, which is about 25 minutes. So here's a quick recap of the stocks that we put out. Start with positive news flow. Wipro, IRB Infra, Godrej Properties, Prestige Estates, Godfrey Phillips, BSE and Satwik Green Energy. Stocks on the other side, TCS, JSW Steel and Poonawalla FinCorp. Let's go across to Manisha now with a roundup of all the action from the commodity space. Manisha, good morning.
Morning, Prashant. Thank you for that. I'll start with the crude oil prices, where we are headed for a very sharp weekly decline by nearly 10%. The prices are holding near $96 a barrel as Israel continues to strike Lebanon, but Israel also is ready to negotiate with Lebanon is the latest coming in from that one. And that's exactly what the markets will watch out for. Apart from, of course, those upcoming diplomatic talks in Islamabad over the weekend. But the West Asia conflict has had a huge impact. The Saudi Arabia oil production capacity is cut by 600,000 barrels per day. 50 oil infrastructure, oil assets in Gulf are damaged, and 2.4 million barrels per day of refining capacity also is offline. And those factors would continue to support the prices at around $95 a barrel level mark there. The crude prices have seen a decline, but we've seen some bit of a gain come in for the metals as a sector. Aluminum is headed for a weekly decline, but copper prices have continued to gain. Zinc actually has been an outperformer in this current week. And then gold and silver are back because of the decline in US dollar. And this is going to be a third weekly gain for both gold and silver prices there. The softer US dollar clearly a supportive factor here.
Thank you very much for that, Manisha. We will slip into a very short break. We'll come back and get you a conversation with the management of TCS on the back of their Q4 numbers. Stay tuned.
Welcome back. Here tuned in to Bazaar Morning Call. Well, it's that part of the show when Hormuz joins us to tell us about all the big movers yesterday and some of them backed by delivery. Hey, Hormuz, morning.
Good morning, Nigel. And we are speaking about private banks during closing yesterday, and they were the big contributors to the Nifty downside in yesterday's trading session. All of them, be it HDFC Bank, ICICI, Kotak, all of them ended with losses of just over 2%. But the interesting bit is the volumes picture. The volumes picture presents something different because HDFC Bank's volumes were lower than its 20-day average. ICICI Bank's volumes were just above or maybe even in line with its 20-day average, and Kotak Bank's trading volumes were half of its 20-day average in yesterday's trading session. Now, even if you take a look at the delivery volumes for all three of them, it was below their 20-day average. For HDFC Bank, the delivery percentage was the lowest in over a month. Kotak Bank's delivery volumes were the lowest in nearly 2 months, and it was also the third lowest percentage of delivery volumes for ICICI Bank in the last 2 months. So the stocks did fall yesterday, but neither were the volumes convincing nor were the delivery volumes. The other major mover in yesterday's trading session was Ola Electric, and and that stock was up 20% in yesterday's trading session. And it's not just Ola Electric, not just yesterday, the stock has been gaining for 5 out of the last 6 trading sessions, and in this 6-day period the stock has gained almost 60%, and it was the biggest single day gain for the stock since November of 24. The volumes yesterday were the highest since September of last year. Close to 80 crore shares were traded yesterday on Ola Electric. The 20-day average is just around 11.5 crore shares, of which 14% of those shares were marked for delivery. So around about 11 crore shares were marked for delivery. The 20-day average is just around about 2 crore shares, close to that. But despite this 60% move that the stock has seen over the last 6 sessions, it is still down 77% from its post-listing high, which is 157 rupees, and still 50% below its IPO price, which was 76 rupees. And the last big mover in yesterday's session was BSE. The markets were down yesterday, but the stock was at record highs in yesterday's trading session. The second highest volumes that the stock saw in the last 22 sessions did BSE. The stock has gained in 3 out of the last 4 sessions. 74 lakh shares traded, the 20-day average of 46 lakh shares. Delivery volumes, though, were half of Wednesday, but higher than the 20-day average. So around about 17 lakh shares were marked for delivery, 20-day average being around 31.5 lakh shares. And over the last 1 month, the stock has gone up almost 18%, and from its 52-week lows, the stock has almost doubled.
All right, Hormuz, thanks very much for that. So, I mean, actually, if you look at it, right, across the mid-cap and small cap universe, broadly, everything is up 20% from the lows, from the recent lows, from the war lows. I just run a screen on NSE 500, 2-day change, and you'll see that. So, stuff has come up very, very sharply along the way. And I mean, the index itself is, as we've been saying, is despite yesterday's pullback, 200-point pullback, we're 65%. We've recovered about 65% of the entire 12% fall that we've had from the time that the war started. Just a quick look at Asia, I guess, and GIFT Nifty. GIFT Nifty, I think, was up 50 points at 8 o'clock. There's Asia, Taiwan, Hang Seng, and some of the other markets out there as well. Well, I think we want to play out our conversation with the TCS top team. So we sat down, Rima and I, with TCS's MD and CEO, K. Krithivasan, and the ED President and Chief Operating Officer, Aarthi Subramanian, began by asking about, of course, the quarter gone by and how they see growth going forward. Listen in.
It's been 3 consecutive quarters of growth, and growth with profitability. And second important point for us is the client metrics. For instance, the 100 million clients with whom we make 100 million or more, it's now climbed up by 4 in the last quarter. It's come up to 66. And it's been probably the best since the last 2-3 years. And we also are confident about how the demand environment is. Like we announced increment, to all our employees. Like if you remember, 80% of the employees were given increment only 6 months ago. So we have reinstated that.
There's net positive hiring as well.
Net positive hiring of close to 2,500.
Yeah.
And of course, need to talk about what makes us positive is the mega deals, right?
Yeah. And I'll come to that in just a bit. But let me just address top of mind, which is this, all this, geopolitics related. Is that showing up in any way?
There is both direct and indirect, right? Direct is very small exposure for us. It will be about 15 bips on a quarterly basis. But indirect, like the impact on the sentiment and also how it impacts the airlines industry, hospitality industry, tourism. So what would be the negative sentiment it will have? Probably that you will see if maybe we'll see it in other places marginally. But overall, our exposure is limited.
When you said 15 basis point exposure, that is...
What's revenue coming from Middle East, and that got impacted.
Oh, directly from that region.
And that got impacted because of the situation.
And the verticals where this perhaps shows up in some way, sentiment or otherwise? Airlines?
It depends on the clients we have. Like we have a good presence even in telco in that region. Of course, airline and some banking.
So it may show up. I mean, it depends on how long this goes on and in what state.
But at this time, as far as Q4 is concerned, it's about 15 bips.
So growth would have been 1.35% and not 1.2%.
Yes.
What about FY27? Right? You've spoken in the past about this year being a good
year. That's where I'm coming to. One, our order book has been very good. Okay, and we closed about $12 billion of in. And what is included there is these 3 mega deals. Particularly gratifying to us is what's the Marks and Spencer, who've been our client for many years, who have put their trust in us again, extended the relationship with TCS for another 5 years to bring in AI and operational excellence for them. And another pharma retailer in US, they will want us to do a product-aligned operating model. It's a fairly large 5-year deal. And another UK telco for whom we'll do complete tech modernization. So these 3 give us the confidence that clients are willing to sign up for mega deals. On top of that, we have another 17 large deals. So all this and also the current demand that we see makes us quite confident about what's coming up in FY27.
You know, there are a lot of positives in the numbers, but if you have to quibble and nitpick, it would be on the margins, because you had a currency tailwind, and yet margins went up only 10 basis points.
Yes. So there are some investments that we made in the associates, and also we had on the overall kind of, there is some amount of, how do I put it, cross-currency impact, but I think overall we are happy.
Do you see FY27 margins picking up, inching up from here?
See, like we said that we always look at 24 to 26 as our, I'm sorry, 26 to 28. Sorry for that. Yeah, I'm not changing that. 26 to 28 is a band that we want to work on, so we'll aspire and work towards that.
Medium to long term. I mean, that's what you've said.
That's right, yeah.
That's the aspiration.
Yes.
AI, and you've quantified AI, annualized AI revenues, what you've put out is higher, right? It was $1.8 billion. Now you're saying it's about $2.4 billion or so. 2.3. So what could you talk to us about how, I mean, last time we spoke, Aarti, you said it's a layer on top of all the enterprise workflow. I mean...
See, I think when you look at FY26, right, over FY25, I would say that FY26 was a pivotal moment for AI adoption in enterprises, and the shift from experimentation to real projects that deliver value happened this year. So I think enterprise adoption has significantly taken up, and that's where you see in one quarter, we moved from 1.8 billion to over 2.3 billion annualized AI revenues.
The pace is accelerating. So are you going back and renegotiating contracts with clients?
So the run part is where the contract renegotiation is taking place, but the transform is completely new business. Sure. And some of the mega deals that Kriti talked about actually bundle both. So if you look at the mega deals, many of them actually wherever we are the incumbent, we are protecting our existing portfolio but growing the portfolio. So the pricing pressure is on the run, on the IT ops side.
You want to add anything to that? Pricing, in terms of
like she said, what happens is there is a productivity to be gained. When the productivity is to be gained for the same quantum of output that you deliver, that would be done at a reduced price.
Okay, it's very early, but these savings that you deliver for the clients, are they reinvesting on tech spends, or how are they using that?
Because in fact, almost every CIO you have spoken to, they have been telling us that the amount of technology backlog they have, so the surplus capacity they're getting because of productivity gain is they expect to continue to reinvest in spending more and coming out of the backlog.
If I can add a little more color to that, so I think the efficiencies from the run, whether it's on the infrastructure side, application side, or the business process side, is being plowed back into transformation. And 3 types of transformation. One is enterprise transformation, where you have to change your existing systems, modernization, and the third is new AI transformation, which is the layer on top that I alluded to.
Very quickly, but is there any evidence as customers experiment with these new AI tools, is it resulting in a loss of revenues or customers pausing the services, the work that they do with companies like yours? Any evidence?
No, there is no pausing of work, because customers are trying, while they're experimenting, and everyone also, nobody wants to be left behind. So there is an experimentation, they are trying to reimagine their business process, reinvent new products and services. We are not seeing any pausing of work.
And if you have to describe the kind of year FY27 is going to be in one word, what would that be? A good year, very good year, or a word of your choice?
I'm positive.
Positive about it.
Very measured. but good to hear that. Do clients prefer multiple AI models, or is
Aarti can handle, but I would expect, like, see the way how hyperscalers turned out, right? Almost every customer has signed up with, most of them sign up with multiple hyperscalers. Similarly, I would expect most of the customers to work with more than one model.
So TCS is an AI model agnostic integrator in that sense.
And I think, just to add to what Kriti said, I think just like we are multi-cloud, every customer is multi-model, in terms of how they use these models, primarily because the model capabilities are evolving very fast, and different models do different tasks extremely well. So what we are doing is, just to give you an example, if you take modernization, we have created our own modernization platform, which has these models behind. So that's the value we bring, helping customers choose the right models to do the job. And just like on cloud, we saw FinOps. You need model FinOps,
We'll have that.
AI FinOps, because you need, otherwise we could be consuming a lot more tokens we need to do that job.
Sure.
So I think best of models for getting a job done is the way to go.
And on data centers, have you all, sorry, just to get that number, have you all found the land? Because you were scouting for land, and when will work begin?
We're looking at multiple land parcels in multiple states.
Okay. How soon
We are close to signing few. Till we sign, we don't want to disclose what it is, but we are looking at not one place. It's not, we are not looking at one land parcel. It will be multiple land parcels, because if we are signing up with multiple clients, and so each one will want it in different.
So do you think revenues start accruing in first half of FY28, assuming a 12 to 18 month period?
I think so. I don't. It's sometime around FY20, CY20, CY28. Yeah.
CY28 is when.
Yeah.
Just to jump back to that AI thing, are you seeing any evidence of how contracts are priced to more outcome-based? It's something we've heard again and again being talked about. Have you seen it? Is it happening? Away from traditional time materials kind of?
We would expect that to happen. As I say, I was telling, like, the needle will move slowly on this one.
Slowly.
Continues to be a lot of managed services, but within managed services, you sign up to outcomes. So you sign up to SLAs. So in addition to signing up IT SLAs, you're signing up for a lot more business SLAs.
Sure.
So that's the shift.
Sure. Acquisitions, Kriti, I want to ask you. I mean, I think you did give an indication for the last 2 quarters, and you've done a few acquisitions, that the pace will pick up. So what should we expect?
We are actively looking at quite a few at this time, prospects and assets at this time. Maybe next couple of quarters we should be able to announce something.
These are smaller, smaller is all relative.
Like, because we are not going in with the idea that it has to be small or big. We look at how does it fit into our larger scheme of things, and with our vision. So whichever fits in. So it has to be value accretive to us, value accretive to the company, that the people that come to us. So we are not looking at anything for the sake of revenue only.
Is that why you didn't consider a buyback this time? Like, we appear Wipro is announced that they will be doing a buyback this time. You're eligible for one.
No, like, I don't know about the other company, but we looked at, like, we've been talking about, like, we need to conserve some cash for being acquisitive. Yeah.
Okay, that's the conversation with the CEO and COO. We also caught up with the CFO, Samir Siksaria, to understand the impact on margins on account of the rupee depreciation, and the CHRO, Sudeep Kunumal. Listen in to their view.
We had 110 basis points coming in from the tailwind from currency. We had additional 40 basis points coming in from better realization and productivity. Against that, going on our build, acquire, and partner strategy, we have invested or reinvested some parts of it. 40 basis points was on tactical interventions, not promotions, usual small interventions, slightly higher QVA, etc. And the ongoing impact of the labor code coming in, all put together, was 40 basis points. 40 basis points was on higher subcontractors, and 50 basis points was on investments on SG&A, likes of higher recruitment cost, what we have been talking about, partnerships, the flow-through of announcements which we have made through the quarter, slightly higher purpose-driven CSR donations, etc. And some part of it was some delinquency cost on the provision for doubtful debts. And 10 basis points lastly on M&A impact.
Yeah. Gentlemen, good to be speaking with both of you. Samir, it's been a busy time for TCS Treasury, isn't it? With all the movement in currency.
Well, I mean, Treasury is all... Go ahead.
No, I'm just saying, I mean, because the moves have been so large, right? When you converted back, made all the difference in that sense, right? I mean, there was this entrenched expectation that the rupee keeps falling, so a lot of the exporters were not converting. And then now we've got to sort of move on the other side. So just, has that been...
So our treasury has always been busy, per se. But through the year also, if you'd have seen, the depreciation has been consistent.
Yeah.
Our policy has been a steady policy of rolling 2 quarters forward. And we stick to that policy and then look at tactical calls basis how the movements we see. But largely it's driven by a consistent, steady policy.
Sudeep, wage hike this time. What's going to be the impact on margins? What is the range of wage hikes that you are giving your employees?
So, yes, Rima. So, we announced our annual increments for all our employees across grades globally, effective April 1st. The increase will be on similar ranges that we have done in the last cycle. As
mid-single digits, kind?
Mid-single digits and top performers double digits.
And impact on margins because of this in Q1?
I'll leave the expert.
As usual, what we have been taking when we give an annual increment, quarterly margins get impacted between 150 to 200 basis points. So that's what you'd expect.
And Sudeep, in the prior 2 quarters, there was an impact on on the overall headcount because of the whole restructuring that you were going through. You had indicated that you will let go of approximately 12,000 employees or 2% of your headcount to position yourself as this AI-first company. Has that been completed or was there an impact in the current quarter because your headcount went up? And will that continue in FY27 as well?
Yes, so the exercise that we had announced is now over.
Okay. How many have you let go on?
I mean, see, we never had a number against it, right? I mean, we said approximately 2%. So the process was more important in terms of how we look at redeploying people and where we are really not able to redeploy someone whom we let go. So that's where it is. And now the exercise is over, whatever we have announced. And
so as a part of that exercise, what's the broad number that you'll have to let go?
I mean, it was approximately in the range of 8,000 to 9,000 people. 8,000 to 9,000.
And the hiring target for next year?
So the last year we hired almost 44,000 talent from campuses, fresh talent. And we continue to be the top tech talent recruiter in the country from campuses. And already we have made 25,000 offers from the campuses. So we are continuing to hire for demand and we're seeing good opportunities. So we'll continue to build on that.
Does the nature of hiring, Sudeep, change? AI, etc. And the people that you pick up from campuses, freshers essentially, the skills that are required for AI-related work is...
I mean, what we are generally seeing is when we are hiring for talent from these top universities and even through our national qualifier test, when we are interviewing, there are a good amount of kids who are very AI native, they're very seamless, and we have now infused that into our ILP initial learning program as well, where we have now become AI introduced to most of the way we enable our curriculum. So that sort of complements them and they are coming very natural into the whole AI.
Welcome back. Hope you're having a good Friday morning. Well, let's get some fundamental analysis going. Sid Khemka of Motilal Oswal Financial Services joins us on the show. Hi, Sid. Good morning. Good to see you in. What's the view on TCS numbers? And was there any kind of read-through you have for the sector, keeping in mind that the sector actually has outperformed just in the last 45 days or so?
Yeah, good morning, Nigel. Glad to be on the show. I think if you look at the broad numbers are mostly in line with expectations. But what we are seeing is that the overall numbers are not that great either. And due to a lack of near-term catalyst, we believe that the stock could remain sideways and the sector could. There's not much to cheer from the Q4 numbers, which was on expected lines. Valuations have become attractive, while the long-term outlook, we still believe that the IT sector could see some growth in FY27, and hence we believe that purely from a long-term perspective, one can look at the IT sector, and that's one sector which benefits from the current geopolitical volatility because of what is happening to crude, what is happening to the rupee, and then what is happening to the other sectors which are getting hammered. And IT as a sector has already seen a lot of selling and hence has been standing strong. So coming back to TCS, I think margins have been pretty strong, but the key concern has been growth. And whatever benefits that they have been getting out from the employee productivity, we are seeing that revenue per employee has improved. But most of that benefits have been passed on to the clients, and hence we believe that given the AI deflationary environment, all the productivity benefits would largely be passed on to the clients, and hence see a stable kind of an environment for IT in the current environment.
I was looking at Nomura's estimate, Siddharth, and for FY27, they're expecting margins to improve only 20 basis points. So 25.2 versus 25% in the prior year. So even though there are rupee depreciations, the actual pass-through to the P&L is there, but not very large on account of the reinvestments that the companies are doing. A lot of real estate updates have come through. The latest one is from Godrej Properties, where they've said that they've achieved 105% of their FY26 booking value guidance. Collections have gone up by 86% on a quarter-on-quarter basis. Real estate sector got hit very hard. Individual stocks are down 25-30%. Is there a buying opportunity in any? If yes, which one?
Yeah, Rima, hi. So first of all, we are not expecting any margin improvement in TCS. So we are maintaining our margins at 25% for FY27 for TCS. So that's a flattish margins expectation. And even on the EPS growth, we are expecting a marginal uptick, 8% kind of growth in FY27. So not much of growth there. In terms of real estate, yes, some of the companies have come out with good numbers, and especially some of the companies with a retail offering. So I think the stocks, the sector has seen a big battering. A, because of the slowdown that was there in the previous quarters, and B, because of the expectation that the crude linked inflationary pressure might lead to some rate hikes in the coming few quarters. So I think overall, valuation-wise, I think definitely some of these stocks looks interesting. So stocks like Prestige Estates, where we have a very positive view, we believe earnings growth could continue to see steady growth going forward. Apart from that, Godrej Properties also is among our top preferred ideas in the real estate space, given that the company is expanding across India now from its home state and seeing good, given the good bag, the brand, the company is witnessing strong bookings across the region. So these two stocks is something that we like, Prestige Estates and Godrej Properties.
Okay, all right. Sid, all that twinkles is aluminium, because from the outbreak of this war, actually, even gold pulled back 25%. And we here at CNBC-TV18 put a piece online, on our YouTube channel, on the gram as well. That has happened in the past. In a bull run, sometimes you see gold prices have pulled back 20, 30, even 35% if you trace it back for the last 45 years or so, and then recovered. But aluminium is twinkling, because of the supply shortage. What's your view on these names? Nalco, Hindalco, and Vedanta. Should someone take money off the table, or it's going to be higher for longer because restarting these smelters are going to take a while? You'd rather say, hang in there.
Definitely, Nigel, I think in this environment, what we're seeing is that the demand for core industries, that is pretty strong. And in that, some of the core industrial metals, copper, zinc, and aluminium, we believe that there is going to be a strong demand outlook over the next few years, driven by heavy power demand for the reconstruction activities, for the industrial growth, as well as the AI data centers that are likely to consume much more of the power requirements that they have. Within the metal space, we like Vedanta, we like Nalco. I think Nalco, the earnings are being driven by the strong volumes growth. Aluminum prices have been pretty steady, and volumes are also seeing improvement because of the capacity expansion that the company has planned over the next few years. I think valuation-wise also, so once the earnings growth picks up, valuations would continue to see momentum because commodity cycles, when in an up cycle, the valuations is difficult to catch by. Even if you look at Vedanta, I think the company is looking attractive, interesting, given that the numbers, it's a play on the entire commodity cycle. You can play copper, zinc, aluminium, as well as silver through Vedanta, and the company's restructuring plan, which will play out over the next few quarters. I think that is also value attractive.
Sid,
attractive for the investor.
Got it. Sid, we'll take a break. We have to take a break, mandatory one, but coming back to you with more questions, technical trades on the other side. Welcome back. The rupee is starting flattish, slightly stronger, 92.57 compared to 92.66 at this point in time. And, it's looking good. Shriram Finance, I just want to kind of come back to it. Stocks back under 1,000 rupees. Sid, if you're there, any thoughts on this one, Shriram Finance?
Yeah, Prashant. So I think if you look at the entire space, got some impact because of the expectation that the higher crude oil price could impact the demand. And if you look at the entire auto sector, that also got impacted. But I think overall the numbers have been pretty strong. That is one company that is among our preferred ideas within the financials. The company has a very good diversified AUM mix, and the recent rating upgrade as well as MUFG's equity infusion, we believe the rating upgrades, the cost of capital will come down, plus the growth capital is now in. So we are expecting that the NIMs to remain healthy, credit cost to come down, and overall we are expecting an about 20% AUM CAGR as well as around 30% PAT CAGR. With while valuations were up, now after the correction, we believe that the stock looks attractive, and we definitely have a positive view, a buy rating, and a target price of 1,200 on Shriram Finance.
Thank you, Siddharth, for joining in. Pre-opening rates are coming through. And by the way, the setup, the handover from Asia has also been strong. So the Japanese market, Nikkei, is up 1.5%. Kospi is surging nearly 2%. The Taiwanese market is up 1%. And the GIFT Nifty is suggesting that after declining 222 points in yesterday's trading session, we could recoup about 150 points to begin trade with. 24,000 should be an immediate hurdle for us to conquer psychologically. And on the way down, yesterday's low of 23,682 will be important to defend. Mitesh Thakkar and Sudeep Shah of SBI Securities are now joining in on the show. Gentlemen, good morning. Thank you for joining in. Happy Friday. Mitesh, beginning with you, what would the trading call be on the Nifty if we get that gap up?
Good morning. So I think my idea is that the Nifty is positively biased in the short term, unless until we see the Nifty break approximately 23,600. So with this gap up, I think the up move or the rebound, the bounce back should continue. We had made a high of around 24,025. I think that should be tested. And over the next couple of days, there's a good chance that we might even head towards 24,300, 350 zone. So that being the first target, I think I'll maintain a positive stance and will not worry about a 40-50 point kind of gap up. If I want to go long, I would still want to take long positions. Though I think slowly, because the stop loss is lower at 23,600, so you might want to add on any intraday tips.
Sudeep, would you go long if we have a gap up opening and we open around the 23,900 mark?
Good morning, Rima. Rima, what we feel is that post this gap up opening, there could be slight cooling off like yesterday we had seen selling pressure from higher levels. So say a 50-60 point dip to begin with, closer to 23,820, 23,830. That would be a good area to go long. The bias is positive post that gap up. Yesterday it was just a day of consolidation. And it was a straight 4-day gain, which we had seen till day before yesterday. So yesterday's cooling off should not be read as some kind of a profit booking or a severe selling pressure. So dips closer to 23,830, 23,820 should be used to go long. 23,700 will now act as a strong support, slightly below yesterday's low. So 23,700, I feel, will act as a support until this holds. 24,100, 24,180 will be the targets that I am looking at in the short term.
Got that. Let's talk about stocks then. Sudeep, which stocks do you have on your radar?
A couple of them. One is from the defense space. Last few days, we have seen defense stocks making a strong comeback. And the strongest of them is BEL, Bharat Electronics Limited. 5-7 days of decent up move, a good base building, and a breakout yesterday. So what we feel is that this can be bought with a stop loss at 429 for a target of 456. The second is an auto ancillary, which is Lumax Auto. So here also we have seen a decent consolidation and post that a breakout yesterday. So we feel that from here on, the stock is poised to move higher and hit newer highs. And this can be bought at current levels as well as on dips of 1710, 1715. Stop loss would be 1700. The targets would be 1800, 1830.
Midesh, your stock calls?
Yeah. On the stock side, I have a buy on Adani Enterprises with a stop at 2019 for targets of 2085. Cochin Shipyard is another one which features on the list. Managed to get past all the short-term averages. So buy with a stop below 1400 for targets of 1470. Couple of finance NBFC companies, Chola Finance is a buy with a stop at 1509 for targets of 1580, and Bajaj Finance is a buy with a stop at 889 for targets of 930.
Okay, thank you very much for that. We'll come back to you and get a 9-10 calls. For now, just want to highlight TCS in pre-open is down 1%, while Wipro has opened up strong on the buyback announcement. Stock is one of the top gainers, 3% up on that. But CLSA has turned constructive on the Indian equity markets. They've made some portfolio adjustments, changing their recommendation on individual stocks. Sudarshan now joins in with more. Sudarshan.
So Indian equities might have surpassed maximum pain point because of West Asia war and its impact. Valuations had slipped below 10-year averages and sentiment had reached extreme bearishness. They are some of the factors why Vikas Jain of CLSA has turned constructive on Indian equities after 18 months of being bearish on the same market. And now these things have led to major changes to his portfolio. And the first one is he has decided to exit ITC and Bajaj Auto in favor of Varun Beverages and Mahindra. Expects better post-war setup for Vedanta, and that's the reason it prefers Vedanta over Ultratech. And L&T is seen as a post-war recovery play and bring it in place of defensive bet, that is NTPC. He sees better risk reward in Bajaj Finance than IndusInd Bank, and he has raised overweight on financials and cut the stance on IT to underweight and has swapped Tech Mahindra with HDFC Bank. Some of the stocks that he continues to hold in the portfolio, and those stocks are ICICI Bank, SBI, ONGC, Tata Motors, both passenger vehicle and commercial vehicle, Infosys, Avenue Supermart or say D-Mart, Eternal and Godrej Properties.
Thank you very much for that. Good to see a bullish call coming through on, the Indian equity markets. In the morning, we were talking to Nomura. They downgraded India to a neutral. I remember the conversation that we had with Amish Shah. They were forecasting a sharp down, just 8.5% EPS growth. So they too had turned a bit cautious on India. So India's environment, which was supposed to be a benign inflation, high growth, high earnings recovery story in FY27, sort of changed on the back of the war, the elevated crude and oil prices, and therefore there were quite a few downgrades, and now it's good to see CLSA turning bullish. But in fact, yesterday in our special conversation, it was a commodities town hall. We also spoke to CLSA's Vikas Jain and ICICI Prudential AMC's Anand Shah on India, the valuations, the top themes to watch out for. Listen in.
There are three things which typically define market moves. One is valuation, second is sentiment, and third is narrative. Say 18 months is what you mentioned, say sometime towards the end of 2024 or around that time, second half of 2024, we warned that all three things were adverse. We were at really premium valuations, and this was the first sign of China waking up. Our sentiment, now we have a proprietary sentiment gauge. It's called the India Bull Bear Index, which gives us investor sentiment in a quantitative way and not in an anecdotal way. That was at 97% bullish. And third thing, our narrative. Narrative was super positive about India, as if nothing could go wrong. I think from that point onwards to now, sentiment is 1% bullish. This was the reading on 30th March. That's the most negative sentiment for me has been, other than COVID and GFC. That's how negative it was. Valuations are far more palatable. It's below 10-year average, slightly above 20-year average, both on an absolute and relative basis. What is pending is narrative. And narrative is something which typically follows performance. So I think I would say that valuations are not mouth-watering, but they are far more palatable, near average levels. So the complaints that someone had from India should reduce significantly, given 2 out of those 3 factors are now in our favor. See, I think there are 2 ways of thinking about AI. One, that AI will eventually be something that will do all of things, everything on its own. The other, that it will just make whatever we do a more efficient, give it a more efficient way of doing things. See, if you believe in this latter, then you would need some intermediary to give you solutions to make it an efficient use for you. Okay. So if that is the case, very simply put, then that's where some of our IT services companies could get up their jobs. So that is our thought on the sector, that unlike the popular belief that it is lose-lose for IT services, that's not going to be the case. The advantage of having a young population is we are able to leapfrog rather quickly. Like we leapfrog from 2G to 4G. So the usage of AI can catch up far faster in India.
In terms of opportunity into the next decade, I think one we have obviously said, which is manufacturing will make a comeback, and a lot other factors than just inflation and rupee depreciation. There is very clearly a need to have more and more supply chain under control rather than dependent outside. So there will be opportunities in manufacturing, which was not the case for almost 10 to 15 years. Within consumers, we have a preference for services over products, because as the per capita income grows, your consumption of products stagnate and your incremental income goes into services. So what we saw in terms of wealth creation in the consumer products, be it FMCG to auto, we will see similarly a lot of opportunities in the services industry as the per capita income grows and India becomes richer.
Okay, well, that was a town hall that we had yesterday here at CNBC-TV18, and more excerpts out of conversations, with our guests through the course of the day, spattering of views coming through. Well, here's a quick recap of the top stocks that we covered earlier this morning. IRB Infrastructure, Prestige Estates, Godrej Properties, Satvik Green Energy, Godfrey Phillips, BSC, Wipro, TCS, JSW Steel, Poonawalla FinCorp are some of the names which we covered with stock-specific information. By the way, I think the pre-open is, of course, settled in a decent way, about 0.4% higher, so it's triple-digit, 23,880. We'll see where we finally land at market open, and then, of course, where we go from here. So lots of interesting price action over the last 2 days. Bounces from the low, some strong, some not so strong, but so many names which are now up 20% from the recent lows. As a long list. Well, I think there we go. First bell going off. It's about 0.4%, 0.39, just ticking open right now. 23,880. Nifty Bank is up 0.8. So it's a little stronger for the banks this morning. 55,300. There is a mid-cap index which is up 0.75%. The small-cap index, I think, is also starting in the green. it's up about 0.9. So 16,720 is where the small cap index is now starting at. 1,500 stocks are higher, 200 stocks are lower. So that is the 7:1 advances to decline ratio. Right to the word go, but this is very early and we'll have to watch this one. Wipro is the top gainer, is followed by Shriram Finances, Bajaj Finance, Tata Steel. On the downside, there's Bajaj Auto, Sun Pharma, Infosys, which are the losers. But it's by far broadly up and about 0.5% on the Nifty. Rima.
Well, TCS is under pressure. TCS has lost 2% at open, 25.38. So it's giving back some of the outperformance that it had, the gains that it had since the start of April when stock rallied 10%. Tech Mahindra, Infosys also opening in the red, along with that HCL Tech. In fact, the entire IT basket, barring Wipro, straight away down 1.5% to 2%. Wipro, though, stands out on the way up on account of the buyback support. Other than that, Sun Pharma is your top loser, so that straight away lost about 3.5%. HUL, Hindalco open in the red, but the cuts are not meaningful. On the way up, Shriram Finance has been a big mover. This month, Shriram Finance has rebounded 18%. And today, it's right on top of the leaderboard. In terms of the banking names, it's Axis Bank, 2% up, followed by ICICI Bank, 1.25% up. And overall, the banking stocks are outperforming today, with the Nifty Bank up 1.2%, outperforming the Nifty and the sensex, which are up 0.6-0.7%. Eicher Motors, there is a new launch there, a Flying Flea EV, and that's gotten the stock excited. They valued it, I think, at 2.7, 2.8 lakh, 2.79, and stock, the reception from the share market to that launch seems to be positive. Stock is up nearly 3%. Tata Steel, BEL, Interglobe Aviation continues to see buying. Power Grid is higher in trade. M&M, HDFC Life, SBI. These are some stocks where the gains are in excess of 1%. But all in all, the Nifty is now building on that gap up opening. We had opened below 23,900 and now we're closer to 23,940, 950.
Well, that's right, Rima. And the current in the broader market seems to be back just in the near term. Even yesterday, the Nifty ended lower. The mid-cap index ended in the green. And today, the mid-cap index is already up 1.3%. Few stocks that are buzzing around. ITDC is up 5.5%. Ola, what's going on there? 22 rupees stock has become 38 rupees, but this stock was 138 rupees as well, maybe 18 months or thereabouts ago. So that stock has seen a big spike up, and volumes are massive on that name. Grow, Billion Brains, that stock is up 3.5%. In fact, for the week itself, Grow is up close to around 18%. So big move is what you're seeing on that name. Another stock is IFCI, I think because of the indirect stake that it has in NSE. That's been buzzing of late. Even in yesterday's trading session, it was up. And today as well, it was up. So, it's moving up in trade today. What else is moving in trade? Well, I think Andhra Cement, is moving from circuit to circuit on a day-to-day basis. It's up close to around 27%. I think a year or so ago, it was a 100 rupee stock, Andhra Cement. It's on BSE listed. So, just keep an eye out on that. There is some kind of murmur that maybe there could be some kind of unlocking of value. We'll have to wait by to hear that. Cohance, that stock is up close to around 6.5%. Decent volumes on that name as well. Net, a good start to trade. Friday evening is going to be rocking personally, but Friday morning for the markets has opened up well in the green. Nifty up 150 points. The Nifty Bank as well is up, and the breadth of the markets looking brilliant.
Well, yeah, absolutely. And I think it's a good-looking screen, right at the word go, 23,945, so 170 points in the green at this stage. Well, let's bring in Dheeraj Agarwal, who's with us, Managing Director at Ambit Investment Managers. Dheeraj, good morning. Great to have you with us here on the program. Thanks for joining in. First thoughts on state of affairs, Dheeraj, and then we'll sort of pick up on individual specific things. TCS, of course, has reported. We'll get to IT in a bit, but broad thoughts.
Yeah, so, there's a sign of relief, obviously, with the ceasefire. It's not all done, all solved yet, but it's certainly a step in the positive direction. I hope things settle down in the Middle East for multiple reasons, global economy, humanitarian, all of that. It's going to be challenging to restore the world to an absolute normal condition as it was before the war. I think the world has changed, but hopefully it'll be better than what it was last month. And that'll be a big relief for markets, economy, oil prices, everything.
Dheeraj, I remember our last conversation where you said that your personal gut is that it's a possibility the Nifty heads down to levels of 20,000. We didn't quite get there, but now that we seem to be on a path of de-escalation, do you see the downside more protected? If you had to make a bet now, your own personal feeling on where the markets are headed from here.
Well, I said 20,000 is a possibility, 22,000 is almost a high probability, which actually happened. I'm not very happy about that because it was a painful situation for the market. But, views and hopes are two different things. So with de-escalation, and let's assume for the time being the war actually subsides and we get some positive outcome from discussions this weekend. I think the immediate large risk to the market goes away. And India reverts to the situation where it was, let's say, pre-war, which was okay, but I wouldn't say very exciting or bullish. So I've been cautious on the markets, even on your channel for the last year or so, primarily because I think we are lacking engines of growth. And you can see that in the way the world markets are reacting at this point. Taiwan is almost close to life highs. Korea is little below life highs. Korea is, by the way, up 40% YTD. Despite the war. US markets are very close to life highs, so is Japan. India is still 9-10% down. So we lack growth levers in the near term. And if the war risk goes away, my view would be that we go back into a sideways consolidation zone for maybe next 1 year more.
All right. Hi, Dheeraj. Good to see you in. Dheeraj, with sideways markets ain't so bad, right? You get your required quantity at the desired price, in a wobbly market or in a market that's consolidating. So you pick up a particular theme that looks good from here, given hopefully the war is behind us, and going by the cues that are getting on the domestic front. Which one would that be?
So two things, yes. I mean, a sideways market is not, it's better than bear markets, right? So it's
for sure.
Sideways market can also be painful, particularly when you see asset prices on the world going up, and yours isn't. It's painful. FIs will continue to sell. They'll keep putting pressure on the markets and so on because, relatively speaking, they'll find other and better avenues to invest. But in a sideways market, select stocks, select sectors can do well. Obviously, the sideways market definition is something goes down, something goes up. And there are investment opportunities. On your second question, I continue to maintain that we are a themeless market at this point.
Okay.
So this is the first time probably in the last 25, 30 years I've been tracking the markets. It's a completely themeless. Actually, 90s was also sort of a themeless market. So this is similar. This is a themeless market. In every sector, we will find buy and sell opportunities. But will a sector do meaningfully better than a sector B, or a theme will do meaningfully better than sector B at this point of time? Is a huge question mark. So it's a stock pickers market. We will have to look for companies which are delivering numbers at reasonable valuations.
Okay, all right. I don't know about the delivery of numbers, but valuations seem to be reasonable in the tech space, at least post the sharp correction that we have seen.
Yeah.
How would you look at this? Because, off and on you're getting these sound bites coming from Anthropic, there's some kind of jitters that are felt, and these companies will not grow a great deal. But is that factored in the price? TCS, the stock is down close to 1.5%. It's seen a big recovery from the lows. Valuations are on their side. And if you look at margins, I was reading a note, if you compare it to pre-COVID, this is one of the few companies that margins are actually better in comparison to pre-COVID. Other companies have seen a margin decline, but the stock is down 1.5%. IT, positive or negative? Your view?
So, I like to simplify things, right? So people track multiple variables, multiple metrics. I just want to simplify it down to say, what's the growth, what's the cash flow generation, what's the ROE? So, you mentioned examples of TCS, but let me just say, most of the large cap frontline IDs, growth rates are down to mid-single digits at best. Now, with those growth rates, the current valuations may not be expensive, but do these names become screaming buys at this price? I doubt it. So that's my view, because eventually equity investors look for growth, unless of course the dividend yields go to a level where it becomes mouth-watering. So I think some of the frontline IT stocks are already at 5% dividend yield. The moment they start going to 6.5, I think you can buy them just for dividend yield. So talking about IT, which is a high growth sector in terms of dividend yields itself, tells you that how the sector has got derated. But within the sector, there could be names which are delivering, let's say, high teens, mid-teens, 20% type earnings growth, where valuations are reasonable for that kind of growth. Those could be a buy.
Harmish just sent me on TCS the Bloomberg snapshot of how many brokerages actually track TCS. And we've got about more than 50. And the key takeaway is that 72% of them are bullish on TCS. Where the target price is higher than where the currently is. They've got a buy, outperform kind of a rating. Hold is 17%, and only 2 sell rating. 5 analysts have got a sell call, the prominent ones being Citi and Jefferies. So at least the target prices and the rating on TCS seem to be more on the upside. Dheeraj, any signs of domestic inflow slowing into the market? We know flows typically track return. The DII domestic inflows have been supporting the market and keeping it afloat right now. But if that support is taken away, then it sort of opens up more downside. What are you picking up from your circles about the strength of the domestic inflows on all sides, whether it's SIPs, PMS, AIF?
So PMS AIF has been slow for last year and a half. If you actually look at the PMS AIF numbers, the net inflow has not been very strong. But I see no signs of slacking on domestic mutual fund side. It's already come down from, let's say, 40,000 crores per month average to 27,000 crores per month average. From talking to my clients, friends, colleagues, I don't see that number slowing down yet. I think the risk on that at this point of time seems pretty low. But I will point out a different risk in that context. So till a few months ago, as per rough estimates, domestic mutual funds were sitting at about 7% cash, 6.5–7% cash. Last 2 months of aggressive FI selling, which means a very aggressive DII deployment, I think those cash levels would be down to below 3% now, right? Because the cash at 6%, or let's say give or take $60 billion mutual fund AUM would be $5, $6, $7 billion. Last month itself was very aggressive FI selling, very aggressive DI deployment. So the dry gunpowder is running out, and if FI selling persists, even with this kind of domestic inflow, the fund flow situation will become a bit negative going forward.
Any other sectoral views that you have, Dheeraj? You gave your opinion on IT, but what about large banks? What about the consumption names? We're getting a lot of positive views on the premium discretionary consumption side, saying that it is seeing a bit of a recovery.
It is, and consumer discretionary is seeing a little bit of a demand tailwind at this point. And again, see, banks, there is nothing wrong. Large private banks doing well, there is no NPL challenges, but most of them, actually I won't say most of them, there are few where valuations offer not much of an upside, and there are few where valuations offer a little bit of an upside like room. So there is literally no sector thematic. You can buy a couple of private banks, you can avoid most of the private banks. Similarly, in consumer discretionary, there are 2 or 3 or 4 buy ideas, maybe not everything. So it's literally the kind of market that we used to see in the 90s. That let's say there are 4 great banks or 4 great consumer discretionary companies all growing at broadly similar rate. Then you have to see what the relative valuations and how it stacks up and where there is upside and where there isn't. This is very, very different from the market that we've been used to in the last 10 years or 15 years. When one theme moved up, everything moved up, irrespective of what the valuations were. Most notable of that phase was 2015 to 20, when consumer stocks were going up irrespective of whatever valuations, and 2 or 3 private banks were going up irrespective of whatever the valuations are. That era is not coming back again in a big hurry.
Yeah, got that. The thing is, Dheeraj, for people, for the vast majority, the investment opportunities, of course, you can invest outside markets, and many do actually. But for the vast majority, it is very much still the market here, right? The home market. So it's this against that, not India against Korea, but This stock against that stock, or this sector against that sector. When you talk about relatively what will do well because you want the best return on your money. So yeah, I mean that's the context, I guess, for most. You'd agree, Dheeraj, right?
Yeah, I would totally agree. Except that what has changed as compared to the previous market cycles and this one is, in previous market cycles, you could say financials look good. Let's just buy financials, right? Or let's say capital goods look good when the government capex was roaring away, or especially the PSU-driven capital stocks look good. Let's buy all capital goods stock, and this whole sector did well. Now you'll have to sit back and decide, just to take names as examples, not as recommendations. ABB could be a buy, but Siemens could be a sell. Right? So buying a basket of ABB and Siemens will not really help the portfolio. Similarly, let's say Axis Bank could be a buy and ICICI Bank could be an avoid because of the valuation difference. So that's the incremental challenge investment managers, professional investment managers, as well as retail investors investing directly in the market now face. So it's harder. I mean, even YTD, for example, 125 stocks out of BSE 500 are positive, despite a sharp sell-off in the month of March. Of which the top 10 names are up between 25% to 50%. The top gainer in BSE 500 is Hitachi Energy with a gain of 55%. But Hitachi Energy gaining 55% doesn't mean all capital goods stocks have done well. I mean, most of the capital goods are down deep in the red, YTD, but Hitachi Energy is up 55%. So this is the incremental challenge the current shape of the market presents. It has to be very carefully bottom-up stock selection kind of a market. In a market where only 20-30% of the names give you decent returns, you can see how difficult the investment job is. So I think the easy money era is over. One of the marketing trips from Ambit, I met a client in Delhi and he said, I'm making 10% a month. Can you do more than that? I said, if you can deliver that, I'll give you my money to manage. I think that era is over.
Put the 10% a month guy in touch with us.
Yeah,
We'd like to get his views.
Dheeraj, tell him I'm okay with 2% a month. We'll correct after the show.
No, I mean...
2% positive, huh?
Dheeraj, but in a way, right, that's a more normal kind of market, right? So, thematically, when you're just buying themes, it's easy and you're riding the upside because there is momentum behind these themes. But that also typically does lead to excesses, right?
Absolutely.
Because it's themes at the end of the day, and you can justify anything because it's a theme.
Right. I totally agree. So it is actually a market where, just to put it a bit humorously, it's a market where analysts and fund managers have a job. For a while, it looked like a market where one didn't need analysts and fund managers because you could just buy a theme and just say, I'm the smartest of the lot. I've just bought a basket of defense names and come what may, this sector is just going up. So who needs a fund manager or an analyst? Now, out of the 10 defense names, 3 might go up and 7 may not. So you will have to sit back, analyze and do stock picking. So yes, you're right. It's back to basics. Easy money is not there. It's back to basics. There are money-making opportunities, but it's harder. It will require some real hard work and incisive research.
Thank you, Dheeraj. Great chatting with you as always and getting in your perspectives and insights. Moving on now to our next discussion. Now, after more than 2 decades of scientific effort, India has crossed one of the most consequential milestones in its civil nuclear program. The prototype fast breeder reactor at Kalpakam in Tamil Nadu has achieved first criticality, and with this, India decisively advances into the next stage, the second stage of its 3-stage nuclear power program. To discuss this, we are joined by Nikhil Nigania, Director, Senior Analyst, Bernstein, and Karthik Ganeshan, Fellow and Director, Strategic Partnerships at CEEW. So, gentlemen, for those who are not very familiar with all these terms, this fast breeder nuclear reactor achieving that, criticality, the first stage, moving to second stage. So, Nikhil, if I may start with you, can you explain simply what actually has happened, why is it so significant, and what lies ahead?
No, absolutely. So if you look at India, we have a 3-stage nuclear plan, which was laid out many years back. So in the first stage, which is what we have, the operating plants right now, about 9 gigawatts of capacity, we are using mostly natural uranium as a fuel. The output of this is a spent fuel, which is planned to be used in the second stage, plutonium along with uranium as well. So this second stage is the fast breeder stage. And the end goal is to reach a third stage where we will extensively use thorium as a fuel. And India does not have uranium. We don't have a lot of uranium reserves, but we have one of the highest thorium reserves in the world. So the end goal is to reach a third stage where we can start using thorium as a fuel. And hence this second stage was critical, which took us almost 20 years actually to reach. But now finally criticality has been reached for this power plant.
And how long does it take? So now we've, successfully completed phase 1, stage 1. We move to stage 2. How long do you think stage 2 takes? When do we get to stage 3? Because we have this big ambition of, by 2047, achieving significant, I think 100 mega, I'm not sure what the number is, but of nuclear energy by the time we get to Viksit Bharat.
100
gigawatt, right?
Yeah. So we have a goal of 100 gigawatts by 2047. It's ambitious, but very well thought goal. To reach there, I think irrespective of whether we reach stage 3 by then or not, I think we still can do it with natural uranium or enriched uranium, which we can buy from Russia or France or Canada. So that goal, I think, irrespective of stage 3, can be reached. But to your other question, from stage 2 to stage 3, it can take decades, in my view, till we build enough reserves of plutonium to blend with thorium and then go to stage 3.
Enough reserves of uranium, right? Uranium-233 from out of the second stage, yeah. Because you'll need many more of these fast breeder reactors to get U-33, which then goes into the third stage along with thorium. So let's get Karthik into the conversation as well. Nikhil and Karthik, good morning. Prashant here. Karthik, yeah, exactly that question. Actually, we'll come to implications for the private sector and companies enlisted in profits, etc. in a bit. But just your thoughts, initial starting thoughts.
As Nikhil has already said, I think we've got a program that's scientifically sound, which they've obviously put their weight behind for many years. And they've come up with this victory. When I was coming out of grad school in 2012, there was hope that the PFBR would actually attain criticality. It's 14 years since, and, they've just about done it. It's not yet production quality, right? They will still be going through tests to see whether it actually sustains and whether we're actually able to control the heat and then generate electricity out of it. And as we said, it might take maybe another decade before we actually have even another reactor that actually on the PFBR platform. That said, the main challenge that I feel with this approach that we've taken is the scientific system seems to be behind this technology and this approach, whereas the economics system and the regulators that control our electricity sector, they don't seem to have the vision to sort of look that far beyond and say, what, I want us to commit to the resources that it will take for us to do the scaling. So while 100 gigawatt has been laid out as a wish list, getting there really requires the financial system and the electricity sector regulators to recognize that signing up for something that will actually hold you in good stead over 50, 60, 70 years is something that we need to sort of put our weight behind right now. And that's not quite happening yet. And that's one of the reasons why the first stage itself has floundered, right? So we need to have many more reactors of the first stage and the second stage before we actually get to a stage 3.
Yeah.
Hopefully,
Karthik, but the legislative push is there, right? I think the Parliament passed that nuclear bill.
Yeah, exactly. So the Parliament has passed the bill, and absolutely there is, of course, the private sector that's going to be involved coming in. But the thing is that it is very much NPCI-led story so far, which means that it is subject. So, for instance, one of the reasons why we've had these problems is, recovering schedule when you actually have a delay and justifying the investments that are required to recover the schedule, which will actually prevent us from massive cost overruns, requires this full legislative process to be acted on, which doesn't unfortunately help improve the pace of construction. Yeah. So to the extent that, it's going to be the stranglehold of the public sector, it is going to be challenging, but at the same time, all of the talent currently exists in this public sector setup. So we have to really see that the public sector comes out and says, you know what, I'm willing to share all of my know-how and talent to then effectively drive it. But unfortunately, even with the top brass, what we've clearly heard is, yes, private sector can come in, there'll be suppliers, there'll be vendors, but it'll still be a public sector program. It's great for safety. It's great for a system that we know will work for the people. But whether it'll actually scale at the pace needed given the current approaches and constraints is definitely a big question.
Yeah, but Karthik, I've spoken to companies like Tata. This is before the bill got passed in the parliament, like Tata Power, etc. And they've said it's a process, right? I mean, because NPCI is the sole custodian of nuclear energy plants. It'll take time. I mean,
Absolutely.
for these
it'll
technology
take time.
transfers.
It's just that now 70 years, Prashant, right, is a fair bit, right? 70 years is a fair bit. We've put a fair bit of time. And just to give a quick example, there is this technology company called Clean Core CCTE, right? Clean Core Thorium, and I think it's energy. So effectively, what they've taken is not this full-fledged stage 3 type approach, but they've effectively enabled the use of thorium as part of the fuel mix in the current system that we have, PSWRs that we have. The person that's actually started this came from the Indian Atomic Energy System, right? So clearly, when the private sector comes in, we know that innovation and new approaches to basically help scale and build new things is massive. We just need a public sector system that acknowledges this and does this faster. To be honest, we don't have another 70 years to get to stage 3.
Yeah.
Right.
Yeah. Oh, you're saying to use thorium in the current thermalized neutron reactors that we have? The current...
Exactly. A new technology has been developed literally in 8 years' time. CCT has started in 2017. In 2025, they filed a patent, and now we have a technology licensing regime for ourselves.
Okay. Got that. Now let me just tell you, we spoke with a company called MTAR Technologies yesterday, and so they said that 70% of the core of this fast breeder prototype, which has now been was developed by them. It took 10-15 years, and now of course. So is that a Nikhil, from an opportunity standpoint? Is it large? MTAR told us that because you need to build many more now, right? I mean 10, 15, whatever of these fast breeder reactors. The value of work for them could be about 1,500 crores from if they were to do what they did for this prototype.
I think the fast breeder itself, how many will come and how fast, difficult to assess, to be honest, at this point, as this is also early stage. This is a certain criticality. But if you talk about the first stage itself, where we'll be building many more plants, nuclear plants, which NTPC is building, for example, or NPCIL is building in Kudankulam. So those plants, there are many equipment plays. MTAR is one, which we don't cover. L&T is the other one, building most of them. And per plant, it's almost 20-25 crores a megawatt. So it's a massive opportunity, right? So 100 gigawatt is a huge number in that regard.
Yeah. Is there investor interest, Nikhil, or it's kind of largely overlooked?
No, incrementally there is, and not just in India, globally. So unfortunately, in India, they are not very clear direct plays. So apart from L&T, MTAR, as you said, KSP Pumps, another one which makes pumps, which we don't cover. And on the asset ownership side, NTPC plans to build one, possibly Adani Power or a Tata Power as well at some point. Interest is definitely there globally, incrementally in India, but we don't have very clear direct plays yet.
It really comes down to the offtake, right? Ultimately, if we basically see that the offtake for the electricity that nuclear will generate at a fixed price may be higher than what you have currently selling today. If the offtake is there, that's when the financial system will basically start putting its weight behind it, right? So there is no clear order book for that massive size right now, Prashant, right? That's the main problem. And the order book will come only when utility say that I'm willing to get into a PPA for the next 45-50 years at 7 rupees a kilowatt hour, which is higher, but it gives you this immense amount of base load capacity, which can actually also be tweaked up and down. But we just don't have a system that can actually accept that pricing regime over 45-50 years. Everybody will be like, no, I want something that's cheaper, that's not as much lock-in. So yeah, it's a different approach to really getting nuclear on board at this scale. I think we need to really learn from what France did post the first oil shock in 1973.
Yeah, with nuclear as well, Karthik, you would agree that this thorium approach is the right one, right? Because fast breeder technology is not new, it's old. But the point is, it's not a stable system, and that's why countries have not adopted it. But the fact is, we don't have uranium. We have a lot of thorium.
We've put all our eggs in this 3-stage basket, which is great, and I think it can really hold up. But the thing is, a country like China, which also, I would say is not super endowed with a lot of uranium, they've got at least 10 different technologies that are currently being tested. Given the regime that they have, one can argue whether it's the right one for India or not. So many of them are up and running at pilot scale, right? Molten salt reactors, liquid sodium cooled reactors. There is at least a possibility that you'll get a winner. But the thing is, when you just invest so heavily in one, you better come out of this successfully. Now, clearly the thorium-based option is something that will work for India if we chug at it. But the thing is, there is this thing about bringing yet another, few hundred million people out of, I wouldn't call it energy poverty anymore, but really low levels of energy consumption. So we don't want, the power minister to come and say, let's build yet another 20 gigawatt worth of coal, when you know that could have been a nuclear power plant doing exactly what the coal-fired power plant does. So scaling it right now is a challenge, and we need to see what will get us to that scale. And I think combining that with a lot more R&D spending and diversifying what we are chasing, so that we build that case.
Yeah.
But I think the system does not have the resources that it needs. That's what I've heard from the insiders there, at least. Yeah.
Got that. That's useful. And of course, when we talk about all these new technologies, every generation dreams of fusion, right? So that's the ultimate. So there is work going on that as well for, I guess, decades, and we'll see.
Yeah.
Sorry, Karthik, you want to add quickly? 30 seconds.
I think there are startups, by the way, in India. There are startups in India that are looking at fusion. India is very much part of the effort of fusion that's happening globally. So, yeah, I think we'll get there. We'll get there. I guess, not for this Friday morning in any case.
All right, thanks very much. Karthik, appreciate it. And Nikhil, great to have you with us here on CNBC-TV18 as well. Appreciate your time, both gentlemen. We'll take a quick commercial break here. We're going to come back. We have the BofA Securities' Arvind Maheshwari on markets. So where are we headed? What's the shape of things to come with Arvind in a bit?
Welcome back. Well, markets in fine fettle this morning. 200 points on the Nifty. We're approaching the 24,000 odd mark. And the Nifty Bank, all the losses that we saw yesterday of around 900 points odd, that's been made up. But the reason your portfolio is feeling good, because the breadth of the market is splendid. We've had a few very, very rough days. Appears the breadth of the market has turned, and there is some interest that's coming in there. 10 stocks advancing for a stock that's declining. To help us out with what's the way ahead and where do we place post the correction, we are joined by Arvind Maheshwari, the head of India Equities, BofA Securities. Hi, Arvind. Always good to have you on the show. Well, we spoke a couple of months ago, and we have been saying, well, a 10-12% return for the year would be par for the course. Well, that wasn't to be, because no one saw what came next. The AI sell-off and then the war in the Middle East. Post this correction, how are you feeling about Indian equities right now? And do you think we'll be lucky to get away with a double-digit return just in the next 12 to 18 months?
Thank you again for having me here. It's always a pleasure. And yes, who would have thought the world's in a different place in just a few weeks' time. I think we've taken a lot of punches. We started off with the whole AI thematic and how India, which had for a good 3-4 years post-COVID recovery phase, India was the only large emerging market that was of interest to foreigners, where investors could put in serious money. We had visibility on earnings growth. We had political stability. We had domestic demand resilience, and we had the tailwind coming from the thematic of supply chain diversifications and the China Plus One thematic. So it was a moment where India could do nothing wrong, and then suddenly things turned. We had the AI thematic in play. We had India's earnings decelerate. We had a couple of years of single-digit earnings growth.
And at the same time, we had other emerging markets come in into favor with relatively attractive valuations, especially compared to India's premium valuation. So a lot has happened, and then we had the West Asia crisis unfold in front of us, and that has given us another shock. So I think we have taken in a lot of punches, and while the near term is definitely still uncertainty still clouds us, but in terms of where valuations are, I think we feel much more comfortable calling for positive returns from here on.
Arvind, hi, good morning, and good to see you back on the program here. So what's the feedback from foreign investors? There's this one story on Bloomberg that I was reading with all this, and this is kind of the new incremental thing, so I'm just focusing on that. Maybe too much is being made of it, but the Reserve Bank of India pushing against too much excessive currency speculation recently with the measures, which have been successful. I mean, the story on I was reading on the Bloomberg that foreign investors perhaps citing that as one reason why they'd be. I mean, is there negative feedback, negative pushback to this recent policy action? Arvind, anything you can tell us?
See, any policy actions that get taken are at a point in time, and I think we are trying to grapple with foreign equity outflows on one side and then falling currency on the other. And we dealt with that for a period of time, and the currency investors would say, oh, look, the equity markets are seeing outflows. We think there will be pressure on the rupee, and then the equity guys are saying, oh, the currency is falling. We think we should step away from equity. So something had to be done, and the measures were taken. I think the foreign equity outflows at the end of the day that we are seeing is a symptom of the problem, and the problem is that India earnings story got decelerated over the last two odd years, and we need that growth story to come back in, and we need to see that momentum come back on corporate earnings, and that's what is going to ultimately drive market returns, and the foreign flows will follow from that. It's not the other way around. It's not like equity outflows is what is driving markets down. I think it's the other way around.
Arvind, do you think we need a new story in that sense? New story to tell, for the lack of a better way to put it, out of India here? Because, I mean, it took two kind of attached to the hip to global news flow and what's happening elsewhere and how that market is more attractive and how, you need something new out of here, a new impulse, a new story.
Yeah. I think some of this will always remain with us. I don't think we can tear away from the fact that we are in a connected world, and financial markets globally are in some form or shape connected, and we will have to bear the tides as we swim or sink with it. So some of that we can't wish away. In terms of a new story, I don't know how much of this is going to be new, but it definitely feels like we are caught in this bind where suddenly the earnings momentum has taken a hit. We started the year thinking we probably get to about 14-15%, and now we got the war, and we had to cut earnings down to 8.5% on the Nifty, and that's hard to predict. But what can be said that our SIP flows are sustaining. The tariff overhang is gone. The valuation comfort has come back. We are at almost the post-COVID lows in terms of valuation. So ultimately, if you have to, there is buffer coming from the fact that we are at levels of valuation where even a little bit of impulse on earnings growth, and we get to say 10, 11, 12% earnings growth, and that should drive at least in line with corporate earnings returns for the market. So 10-12%. Hopefully we get some PE multiple re-rating as well to add to that, and we could be looking at comfortable double-digit earning market returns from here on as well. And not to forget the currency itself. We've seen massive depreciation of the currency. So this is all obviously predicated on the fact that things don't worsen from here on the geopolitical front, because that's obviously something that nobody can really call at this point.
But India continues to underperform?
In the near term, well, I think the way to look at it is what underperformed going into the war or through the period of that war. If you look at emerging markets in general, they saw $78 billion of outflows across the EM space from foreigners. And at the forefront of that was Korea, Taiwan, India. They were the most sold markets in that period. We are 12.5% now of the emerging market index, and we took 25% of the foreign outflows in the last 3 months. So the expectation is that the markets which got oversold in this in the run up to this war or into the war will probably see the sharpest bounce backs as well. But that's very tactical, very near term, given how light positioning has become and how oversold on every possible parameter that you look at, how oversold this market is, how bearish the positioning is. So you will definitely see a tactical bounce if this truce were to hold for India. But for that bounce to sustain and get a meaningful upside on, I think we need to build it more broad based on fundamentals.
Got that. Thanks very much for joining us. Good speaking with you, and talk to you again soon, Arvind. Appreciate it. Well, that's Bank of America Securities with perspective on markets from here. Nagraj Sethi of HDFC Securities is with us. Let's talk about here and now. So we got a nice move. Nifty Bank is up almost 1,000 points. The Nifty is up at about 200. So basically recovering everything we lost yesterday. Nagraj, good morning. What would you trade, and indices first of you, and then specific trades?
Hi, good morning, Prashant. Yes, market has reversed its trend, no doubt about that. The huge gap that formed on 8th of April, the bullish breakaway gap is significant. Market was moving in the lower tops and bottoms since then. And the way it has after the bounce back, I think this could reverse now. The higher tops and bottoms are likely. I think this gap remains to be open at least another 1 or 2 sessions, and we are likely to move up further. The next upside target would be around 24,500 for the Nifty in the near onwards. And in Bank Nifty has witnessed a significant bounce back. In fact, outperformed the Nifty. The overall chart pattern is looking positive for the Bank Nifty, and 57,000 is going to be the next hurdle to be watched in the Bank Nifty. I have 2 stocks from the long side. First is one from financial side, GM Financial. Chartically, this stock has been in a consolidation phase, witnessed a decisive breakout in the last few sessions, currently placed at the edge of breaking above a crucial trendline hurdle on the weekly chart. The overall chart pattern is looking very positive, and the worst period for this stock price seems to be over. Currently trading around 134.50, one can look to buy at this point of time. An immediate target would be around 144, 145, one can place a stop loss at 130. Second one is Shipping Corporation of India. This stock was in a consolidation phase over the last 1 month before bouncing back recently from the 200-day EMA support. And currently trading around 244.50. The chart pattern is looking attractive. One can look to buy at current market. The immediate target would be around 240, 255. One can place a stop loss at 239.
Yeah, I got that. Nagraj, I just want you to your thoughts on this Sammaan Capital as well. So if you can pull the stock up. So CRISIL has upgraded their rating on Sammaan Capital. This is erstwhile Indiabulls Housing Finance. To AA plus stable. So I think the notification came this morning, and they're of course citing the upgrade in light of the acquisition of Sammaan Capital by IHC Group. They're saying strategic importance to strong support from IHC, sustained strong capitalization, robust buffers, and a pivot to growth. This was expected that there would be a rating upgrade once the IHC money comes in and the transaction is approved. And there is a rating upgrade which is materialized for Sammaan now from CRISIL. I think last time we spoke with Gagan and we've had these conversations in the past, there has been specific guidance about what this will do to their borrowing costs at Sammaan Capital. So, maybe we can look at those that specific guidance with perhaps some perspective later on. But just a quick view on the stock, if you have one, Nagaraj. Have you looked at this?
Yeah, I look at this, but chartically it's very positive. Was moving in a range over the last 3-4 months. 155, 145 has been 140 has been a range for the stock price. Currently placed at the edge of moving above the 155, 160 levels. The chart pattern is looking very positive, and technically we believe whenever the underlying breaks above the larger consolidation pattern, it automatically opens with a sharp momentum. On above 155, 157, I'm expecting a sharp momentum on the upper side likely to take place, and that could take this stock price to around 165 to 170, which is going to be the next hurdle in the next at least 1 month.
Thanks very much, Nagaraj, for that. That's Sammaan and other stocks that Nagaraj put out with regards to trade. Sun Pharma is in focus. Ekta is here with more. Ekta, good morning.
Morning. Well, yes, Sun Pharma is in focus because there are reports, an ET report which has, shaken the stock up, is down around 3% where Sun has decided to proceed with a bid for the pharma company Organon. The binding offer for this bid is expected to be $12 billion. So the company has completed a due diligence that lasted over 3 months, and they're finalizing a financing package which is before the submission of a firm offer in the coming weeks. So at least 3 global banks have been mandated last week to back the bid, and 2 other bidders for the firm are also in the race. That includes a buyout fund and a combination of strategic investor, including an EU buyout fund. Now, Sun Pharma, if in case it does go ahead with this kind of binding bid, it will be the company's most ambitious overseas acquisition and will be the largest global M&A involving an Indian pharma company. Now, just a bit on Organon itself. The market cap is around $1.5 billion. The stock has corrected over 15% this year. The company specializes in women's health. It is a spun-off segment of MSD, which is basically Merck, Sharp and Dohme in 2021. And when that particular spin-off took place, they acquired debt of around $9 billion plus. They reduced it to around $8 billion plus. And as of now, I think that is the key reason why you're seeing the street fearing such a large acquisition, because they will be taking on a large amount of debt. Just a little more details with regards to this. Sun has around $3.2 billion in terms of net cash on books. And one of the key reasons why the street is fearing this possible acquisition is that the net debt to EBITDA is around 4 times currently. If in case they do combine both the entities, it will come down to around 2 times net debt to EBITDA, but it's still a large piece of debt to take on for Sun Pharma, which has been quite conservative in terms of acquisitions before.
Thank you very much for that. So, Street concerned about the potential leverage on Sun Pharma's books were they to proceed with this acquisition. Thank you very much. We will get into a break. On the other side, Manisha will talk commodities. Stay tuned.
Well, welcome back. We're shifting focus to commodities. Manisha is here with a focus on oil as we wrap up this week. Manisha, morning.
Morning, and thank you for that, Prashant. Well, it's just a busy week that we have seen in case of crude there, and the news headlines also continue to be like that. On the weekly basis, well, yes, we're down by nearly 10%, and this majorly comes in from the kind of decline that we saw on Wednesday when the ceasefire conversation was just about started, holding around $96 a barrel on your screens, and that is as Israel continues to strike on Lebanon. Having said that, Israel has said, and there are some statements and various reports, etc., suggesting that Israel is ready to negotiate with Lebanon directly as well. Markets will watch out for the closure of Strait of Hormuz, that as a conversation, and that going to be a major point when there is that peace talk in Islamabad over the weekend there. The US, in the meanwhile, also has warned Strait of Hormuz closure and has warned over imposing transit fees in Hormuz. So those are a few things that the street will continue to watch out for. At this point in time, the crude price is clearly off the kind of highs that we started this week on at around 116. So from those kind of levels, we are trading at around 96. Interestingly, what the street is also looking at is a lot of impact coming in. Saudi Arabia, for one, says that oil production capacity for them is cut down by 600,000 barrels per day. Near 50 oil infrastructure assets in Gulf are seen as damaged. And then it also is about refining capacity, and almost 2.4 million barrels per day of that is currently offline. And that has led to various banks and brokerages suggesting that the crude prices could be higher for longer. I'm going to start with JP Morgan, which says that the risk of prices surging if Hormuz disruption extends into mid-May is much higher. And in that scenario, they see the prices at around $120 to $130 a barrel. But if it continues into second half of this year as well, then you could be looking at even higher prices. That is a view coming in from Bank of America, and they're putting that level to $130 a barrel. Citi also says that the global oil could face disruptions of around 11 to 16 million barrels per day over the next 4 to 6 weeks. And their best case average for the next 3 months is nearly $104 a barrel. So most of the banks that we've spoken till time are thinking that $100 a barrel is going to stay on until the mid of 2026. And then, of course, Standard Chartered says that it's nearly 426 tankers, of which 34 are LPG and 19 LNG, which are stranded at Strait of Hormuz. Stancy is looking at Brent to average nearly at $90 a barrel for 2026. And then you have Goldman Sachs, which for the very near term says that for the second quarter, which is the current quarter, they see Brent averaging at $90 a barrel. They, of course, are anticipating higher prices if the conflict goes on or is prolonged. Kotak, on the other side, is put $90 as a support and $105 as a likely target if uncertainty persists. And yesterday, we were talking to Motilal Oswal, where they see the risk scenario for crude and could see the prices moving to $120 to $150 if the current ceasefire collapses. So as I said, most of the banks and brokerages still talking about 100+ kind of levels for the current quarter.
All right. Well, not great news if it does materialize, but those are forecasts at this point in time. Manisha, thank you very much for that. We take a quick commercial break here. On the other side, it's our special segment. It's the economy. Lata discusses the hiring scene with team leaders Ramani Dati and Quest Corp's Lohit Bhatia. Stay tuned. Coming up in just a bit.